Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMBU in Manhattan. I'm also head trader of SMB Capital's Options Trading Desk. So I'd like to talk today about a bad mental mistake that options, market neutral, positive theta options traders make. And that is they test the strategy and they back test it. They go through everything very, very carefully. They figure out all the nuances, they get all the kinks out of the strategy, and then they're ready to take it live. And when they do that, they tend to have a different experience than when they back tested it. When you back test the strategy, then you are doing it dispassionately. You don't have any money up. It's almost like a scientific experiment. So you almost don't care what happens. You hope it works out because then you have another good strategy under your belt. But if it doesn't work out, so what? Just a little bit of wasted effort. You probably even learned something in that process. So it was not wasted. Having said that, let's say you select a strategy, and you'll note that strategy will backtest well. It will perform well in certain environments. Other environments or other market situations, it's just not going to perform well. There's no, however, sustainable market neutral options strategy that will make money in every market and in every market situation. It just doesn't work that way. The best monthly options neutral strategies will make money, let's say, 9 to 11 months a year and lose money 1 to 3. Those are the best ones. And so there are going to be losing months. It just cannot be avoided. And the strategy, any strategy which purports to make money every month is not real, in my opinion. So therefore, let's just accept for the moment that every strategy that's a solid strategy is going to have losing periods. So you'd say, then if you have a loss, no big deal, right? Well, you'd be surprised how many traders bail out on a strategy that they know will lose under certain circumstances because they have a losing month or two, even though that was an entirely predictable part of the process to lose in certain months. Nonetheless, they will bail out. And it's a terrible mistake, because if you stick with a valid, solid, well-designed strategy that backtests consistently with your expectations and backtests solidly, then it should work, unless there's some kind of fundamental change in liquidity or something else fundamental to that particular options chain. You're going to normally be successful long-term with a well-designed strategy. So let's take a case in point. I developed this strategy some time ago called the Heart-Friendly Butterfly, and I did a back test after I had tweaked it a little bit, and I took a look at the 36-month period, August of 2009 to July of 2012. And what I found during that period was the first 12 months was a 57% return with, I think, just one loss. The second 12 months was a 39% return. I think there were a couple losses in that year. And then the last 12 months was problematic. It lost a bunch of times. It lost money up until the final 3 months when it made money, and it ultimately turned positive for the year in the final couple months of that third 12-month period that I was studying. So let's now look at the stats for that particular backtest. And again, this was a backtest. It wasn't live trading, it was a backtest. For that particular backtest, the trade won 30 times, and this is, by the way, using the exact same protocol. It lost 6 times. By the way, 2 of the periods that I'm calling losses were actually zeros, because there were certain periods of time where you cannot trade it according to the protocol. And so there were 6 periods where you either lost money or were not trading it because the protocol prohibited you from trading it. The return over that 36-month period was 101%, which means it's a monthly expectancy of 2.8% if you do the math. So, sounds like pretty good strategy. Worked in a lot of different circumstances. By the way, that rough period I was talking about, that final 12 months included August through December of 2011, when the market went completely wacko because the U.S. Debt had been downgraded by S&P, and European debt problems were occurring around that same time. And so those two combined to make it an extremely volatile market during the last 5 months of that year. So therefore, you would have expected a little bit rougher time in a period like that. Well, let's take a look at that last year, even the worst year. And by the way, when we say worst year, we're saying it's a year where you made 5%. So if the worst that happens is you make a little bit of money, that's a fairly solid strategy. And in this case, if you had quit the strategy 9 months into the year, you would have been down 18%. But if you kept trading through the rest of the year, then you would have been up 5%. So those last 3 months were very solid. So what does that all mean? That means even in the middle of a rough year where you're not only not up money, you're down a substantial amount of money, if you bail out on the strategy after multiple losses, you're normally going to be making a mistake. Again, I repeat, it's got to be a solid strategy. It's got to be trading pretty much the way you would have expected it to once you live trade it against your back test. And if all that's working and you have an expected number of losses, then why would you quit the strategy? What's the logic behind that? And some people really don't have a good intellectual answer for it. All they have is an emotional answer. They're worn out by losing. Well, that's not really good enough, because if you want to be a trader, you have to expect periods of loss, especially when your back tests tell you there are going to be periods of loss. So if you bail out on it right after a loss, you're almost always going to be locking in a loss for that strategies, where if you had the emotional strength to stay with the strategy, you would have been fine. So what's the conclusion of today's video? If you have a solid strategy that tests well and it's trading like you tested it, in other words, everything's coming out the way you expected it to, the pricing you got in the back test is roughly the pricing you're getting in real live trading and so forth, it's essentially performing the way you expected it to, and you're not getting any execution surprises, then you probably have a decent strategy. If you know it's going to lose, then when you lose, you say, hey, a really solid strategy I developed is working the way I expected it to, because part of what I expected were losses. If it's not a good strategy, don't trade it. If it's a good strategy, don't bail out after loss. That's the worst time to bail out. If you allow the strategy to play out under normal circumstances, if it was designed right, and if the strategy is trading the way you expected it to, then you should stick with a solid strategy. Certainly don't bail out right after a loss. That's just foolish, and it's almost always as a result of emotion. And if you're trading with emotion, then you're not trading intelligently. So that's my message for this week. Develop solid strategies and stick to them after an expected number of losses. That's how you will become a successful trader long term. Thanks very much, and we'll see you next week. If you are interested, by the way, in learning more about the heart-friendly butterfly strategy that we mentioned in this video, you go to optionstribe.com, click on the links tab, and you will find a list of products. One of those is the heart-friendly butterfly, and you can learn much more information about the strategy by clicking on the heart-friendly butterfly link within optionstribe.com. It's a very interesting strategy. It responds very well to lots of different market environments, and you might want to take a look at it and learn a little bit more about it. If you have any questions about that strategy, by the way, email me at sfreudberg@smbcap.com. Thanks very much.